Source code speaking. Here, I still get comments about things I never said, calls I never made, every time it traces back to a copycat. Same format, same style, same thumbnails. But they can't clone skin in the game. Some have even linked my ex directly. I'm not responsible for what you hear from them. One video it's going to the moon. Next it's going to zero. That's not analysis. That's hype. Verify the handle on X and YouTube. That's it. Here we discuss both sides. Macro, micro, geopolitics, data, all of it. Even when it contradicts the thesis. This isn't just a precious metals channel, and you'll see exactly what I mean as this year unfolds. Drop in the comments if you're getting value. Watch this completely. 10 to 12 minutes. Every section builds on the last. Skip and you'll get half the picture, which is worse than no picture at all. Now yesterday I gave you a very specific warning. I said if silver didn't hold the 150 exponential moving average on an hourly near $90, we could move down to $84.9 and below. Here we are. Western spot silver is sitting at $79 as I'm recording this. Western futures at 81. The level didn't hold. And if you're new here and thinking this is hindsight, I get it. But go watch the last video. Go check my X, it's all documented, time-stamped, public. I didn't give you 1,000 different scenarios to cover every outcome. I gave you one, lose that 150 EMA on an hourly close and we are going lower, period. Obviously, I'm not making that call based on a single moving average in isolation. There are multiple confluent factors behind it, and walking through all of them would take an entire separate video. But the level was the level and it played out exactly as stated. The reason it didn't hold connects directly to everything unfolding across global markets right now. Let's start with the full picture. In 80 minutes this morning, $1 trillion was wiped from precious metals combined. Gold dropped 2%, erasing roughly $740 billion in market cap. Silver dropped between 10 and 11% in that same window, erasing around $260 billion. 80 minutes. That's not a market reacting to news. That's a market being moved. The US dollar is up 1% on the day and is now challenging highs not seen since January 15th. DAX is down 4%, Nasdaq futures off 2.5%, S&P futures down 2%, natural gas surged 22% today on top of the 50% it gained yesterday. 2 days, 70+% in European natural gas. That's not a blip, that's a market pricing in genuine sustained energy terror. And the Korean KOSPI closed Monday for a holiday, reopening today for the first time since US and Israeli military action on Iran began, immediately crashed over 7%, $270 billion in market cap erased in a single session, the largest single-day plunge in Korea since the August 2024 yen carry trade crisis, pent-up selling pressure from a market that couldn't react for 48 hours, finally getting its moment to price in geopolitical reality. Here's what you need to understand about why metals are doing what they're doing right now. Because on the surface, it makes no sense at all. You have an expanding Middle East war, oil infrastructure getting systematically targeted, energy routes collapsing, and silver drops 11%. The algorithms see a supply shock, price in a growth scare, and hit every industrial metal. Silver carries roughly 52-60% industrial demand: solar, EVs, electronics, AI, infrastructure, defense manufacturing. Energy disruption of this scale hits those demand projections directly. Gold has no factory that needs it, so it holds better. When growth fears dominate, the order is always the same. Gold first, then silver, then platinum, then copper. The more industrial the metal, the harder it gets hit until growth uncertainty fades. That part is textbook, but an 11% drop inside 80 minutes goes well beyond the macro explanation. Now let's look at where silver is actually trading, depending on which market you're in, because this is where it gets important. Western spot $79, Western futures 81, Shanghai spot 91, Shanghai futures 92. That's a $12 premium still intact after an 11% crash in the West. And consider this ratio breakdown. The gold to silver ratio right now sits at 62-1 in paper markets. The mining ratio, how much silver actually comes out of the ground relative to gold, is 1:7. The COMEX vault ratio is 1:11. The LBMA vault ratio is 1:3, and above ground available supply 1:1. One of those numbers has to snap hard. The paper ratio at 62-1 is so disconnected from every physical and production reality that the math alone tells you this resolves eventually. The question is only when and through what mechanism. At the same time, the Shanghai Gold Exchange released its 7th weekly report covering February 24th through the 27th, and silver inventory data is completely gone. Gold volumes reported, silver every inventory line blank, zeroed out. This is the same exchange publishing detailed silver stock data every single week, and Now, during a historic price surge and active geopolitical chaos, they've gone dark on the one number that matters most. When a major exchange stops reporting inventory data mid-crisis, that's a decision, not a clerical error. Ask yourself what those inventory numbers might be showing that they'd rather not publish right now. Add to that silver recently hit $83 before today's crash. Over the past several days, lease rates have been creeping higher. The swap has been turning increasingly negative. For those who don't track these closely, rising lease rates and a negative swap are early warning signals for physical supply stress. It means the cost of borrowing physical silver is rising and the futures curve is pricing backwardation risk. The paper price went to 79. The physical stress indicators are moving in the opposite direction. The COMEX tells the same story. 2.8 million ounces were withdrawn from COMEX silver vaults on Friday alone, pulled from Brinks, Cient, Delaware, and JP Morgan simultaneously. And here's the detail that matters: eligible silver is falling faster than registered silver is rising, meaning total COMEX inventory is still net declining. Don't let anyone distract you with a rising registered headline. The full picture is draining. The Shanghai Futures Exchange also suspended 5 more groups of accounts today for trading violations. Mid-crisis account suspensions during an 11% daily move tell you that someone was playing games with positioning and the exchange moved to stop it. 2 separate Chinese market actions on the same day, inventory data blackout. At the C, account suspensions at the SHIFE. These aren't coincidences. Now the manipulation layer. Jane Street is now the largest holder of the BlackRock Silver Trust. 20.6 million shares purchased in a single quarter. 3.6% of all outstanding shares. Over 87% of their $662 billion portfolio is held in options. They generate profit by creating and trading volatility using massive leverage. The structure is straightforward: build a large position in the underlying asset, run a significantly larger option trade on the side, then reverse to cash out. In India, regulators documented how Jane Street manipulated the cash market to profit from derivatives positions. We've seen the same pattern in crypto. Terraform Labs filed a lawsuit accusing them of similar tactics during the $40 billion Terra collapse. And there's the daily AM Eastern dump in Bitcoin that was so consistent, so mechanical, it became a known pattern in the market, a pattern that only stopped after the lawsuit went public. Think about that, a manipulation pattern. So obvious it had a scheduled time, and it ran until someone sued. The structure is always the same. Build the position, run the derivatives on top, move the price, collect, and who holds the physical silver backing Jane Street's SLV position? JP Morgan, a bank that already paid nearly $1 billion in fines for manipulating precious metals markets. When the firm that stores the metal and the firm that owns the most shares both carry documented histories of market manipulation across multiple asset classes, an 11% crash concentrated into 80 minutes before the new Your Copen doesn't look like an accident. The ones who look up those settlement documents don't need to take my word for anything. During genuine liquidity squeezes, asset correlations collapse toward 1. Everything sells simultaneously regardless of fundamentals. Equities selling, bonds selling, metals selling, dollar rising. That's today. And when the dollar pushes toward the January 15th highs, which it's now challenging, you get more downward pressure on everything priced in dollars. Only oil is holding its ground in this regime. If the dollar breaks higher through that January level, expect additional pressure on equities and metals in the short term. Cash becomes king. Margin calls accelerate and forced liquidation hits even assets with no fundamental reason to drop. Now let's add the geopolitical accelerants, because this is where the oil picture changes everything. The port of Fujairah, the way's only significant oil shipping route bypassing the Strait of Hormuz, was hit by a massive explosion. Iran is directly targeting the workaround routes, not just the strait itself. Iraq has shut down Rumaila, the world's second-largest oil field, producing 1.5 million barrels per day, roughly 30% of Iraq's total output. When tankers can't move through the Gulf, storage fills. When storage fills, production stops. That's exactly what's happening. Oil moved from 72 to 76 today, despite the broader market sell-off. Physical supply pressure is overcoming paper pressure for now. The U.S. has warned of imminent Iranian missile and drone attacks targeting Dhahran, Saudi Arabia, home to Saudi Aramco, the world's largest oil company, sitting on the largest proven oil reserves in existence. Israel has indicated Saudi Arabia may be preparing to strike Iran directly. China has officially opposed us in Israeli military action. The geopolitical fracture lines are now fully drawn, with the U.S. and Israel on one side and Iran with Chinese diplomatic backing on the other. And Trump said publicly, not editorializing, this is a direct quote, "We haven't even started. The big wave hasn't happened. It will come soon." 15 countries or military installations struck. The largest Saudi refinery already offline. Qatar's LNG gone, and the U.S. president signaling the worst is still ahead. Now the honest resistance case, because the people who verify sources deserve intellectual honesty, not cheerleading. Silver broke down technically. The 150 EMA on the hourly didn't hold. In a full liquidity squeeze, even structurally sound assets get liquidated for cash. Western mining stocks are not following Chinese miners. Higher, that divergence is a warning about where institutional commitment actually stands right now. If the dollar continues pushing higher from here, metals face more headwinds in the near term. These are real risks and they deserve acknowledgement. But here's what didn't change today. The sea went dark on inventory data during peak stress. 2.8 million ounces left COMEX vaults. Lease rates are rising. The swap is turning negative. The gold-to-silver paper ratio at 62:1 is disconnected from every physical reality that exists. Mining ratio 127, COMEX vault ratio 111, LBMA 123. And the CEO of Scottsdale Mint disclosed live that a publicly traded company is actively adding physical silver to its treasury management right now. A large amount, unprecedented at this level. Public companies treating physical silver as a treasury reserve asset. The paper price went to $79. The buyers of physical are not stopping. Don't watch the price alone. Watch the inventory, watch the premium, watch the lease rates. Don't trust me on any of this. The data is public, it's documented, and it says exactly what I'm describing. Invest with, not hype.